so much, and it's an absolute pleasure to be here today. I think the discussions up to now have been phenomenal, and I was reflecting with some of our, I suppose, candidates here today, colleagues here today, on actually where the market is now versus where it was when I set out on my sustainable finance journey. And I think it's just phenomenal what's happened over the last, well, what I have witnessed over the last 5 to 6 years. I am a partner in Grant Thornton, where I lead out on a sustainability practice, but as the very kind introduction went through my career history, I did start my career in banking, and a banker through and through. I worked in emerging markets, I worked on rates, I worked in fixed income, and it was actually the fixed income world which at a very opportune time, we began to realise that there was an opportunity within green, and it came around like most things do in terms of what will it do for us? How is it commercial? And I think it provided us with access to markets, it provided us with new investors, and gave us pricing advantages, which, you know, as an issuer is always a really nice piece. So for me, it's been pivotal. I've turned my whole career towards sustainability, starting out in 2018 and being one of the first green bond issuers in the market. Our first green bond was like 7 times covered, 200 investors. It was an absolute dream. But what it did do, and I think what I want to touch a little bit on today, is actually after that issuance, practically, how did things change within the bank? We talked a lot about culture today, talked a lot about how you can set targets, why you would set them. Actually having something in place like a green bond or any other type of sustainable lending, or indeed investing in sustainable investments, really does help change the culture, because now you have skin in the game. And so I want to talk a little bit about that today, a little bit more on the practical side. Having a roadmap for sustainable finance is fantastic. Having regulatory support, government support, these are all the building blocks of success. But actually, if you're sitting here and it's your day-to-day, what does it mean? Some of you might already know there's people who've set targets or who are looking at targets, but actually, you know, how do you go about starting it up? What does it look like? And what does the general market look like? So just a bit of a practical, I've been in your shoes, and what does it look like out there in terms of sustainability? And I think what you'll find is it is a very market-driven agenda. So we have seen a lot of regulation in Europe, particularly, in terms of the Green Deal, in terms of the European Commission, the development of sustainable finance regulatory disclosures, and you know, we look at things like the EU taxonomy, for anyone who's familiar, where you have to report on how much of your revenues, CapEx, OpEx, are going to environmental objectives. It's very disclosure oriented. The Corporate Sustainability Reporting Directive is similarly based, although will provide more information on companies than we have ever had. That regulatory piece is really important, and it is a real driver. But what is interesting about the way that the sustainable finance market has developed is that it has developed from the market participants themselves. And so while we do have, for instance, a green bond standard, which will come in Europe over the next year, 2 years, and is being highly fought out, I would say, at the moment, you know, giving a very sort of high caliber to what a green bond is and linking into all those disclosure regulations like the EU taxonomy. Actually, what I'm going to go through today has been driven by the banks, the insurers, those that want to invest and those that want to issue in the market. And I think that's really important, because the market has found its level, I suppose, in terms of instruments. I think it's probably important to say as well that while there is huge amounts of innovation, realistically what is out there in the market at the moment is a lens. A lot of this is traditional use of proceeds bonds, if we talk about the bond market, or general corporate purposes with sustainability linked elements. There's still so much room for innovation, and I think that having roadmaps, having hubs for sustainable finance is really what will bring and generate that innovation. And I suppose whilst the market has moved along a long way since 2018, I still feel, you know, that there will be a lot of there's a lot of growth to come. So just in terms of that's just myself. So just in terms of the market itself, so I think we could say that it is a substantial amount of issuance in terms of 2023, 2024, and it's around that 8 to 10% of the overall bond market, and there has been sort of big numbers, like it'd be 14% of the general bond market this year, like that's green sustainability social bonds. So it's not nothing, it's definitely trillions of euros. I know that Stephen spoke a little bit earlier on, and the green bond market cumulatively is in excess of 3 trillion, heading towards 4. So it's an established market. I think there's interesting dynamics in it though. So the bond market, whether it's green or not green, it's still driven by market dynamics. And obviously we've had high inflation, we've had high interest rates, we've had a very unstable geopolitical world, and we see that, you know, continued. We have 50 democratic elections, I think, over the last sort of 12 months into the next few months, and then we have a big election overnight tonight in the US. So the bond market reacts to all of that, and I think you see that play out in terms of sustainable finance markets as well. However, they have shown to be very resilient, and you know, there's a bit of work in doing a green bond or a blue bond or a sustainability linked bond, in that you don't just go to market tomorrow and decide you're going to do one. You have to find the assets that you'll fund, you have to set up a program, a framework, you have to do impact reporting, and then you have to convince those that which will buy your bonds or invest in them if you're a fund, that they are legitimate. And so there is a lot of resource, both human and financial, that's required in that. However, despite all of the exogenous factors that would have destabilized some markets, you know, generally, this market has remained very resilient. And I suppose there's a couple of trends that will resonate, I think, with you here today, because actually it speaks a lot to what's gone into your sustainable finance roadmap. And I suppose the growth factors, as we would call them. So there is that regulatory emphasis on sustainable finance. And if you think about what sustainable finance is doing, it is reorientating capital from things which are not sustainable or non-environmentally friendly, for want of a better word, into things that are. It's a investment value chain play effectively. And if we think about you know, where the regulators are coming from and what they see from a financial stability perspective, they see climate change as something which will impact financial stability. The whole European play is around resilience, and it's about securing energy. I know there was a discussion around energy security today. It's about making sure that Europe as a bloc is prepared for a transition to a low carbon economy. And so that regulatory focus has actually encouraged a lot of private companies, banks, insurers to move towards sustainable finance, because that is effectively a mitigant for a risk that is climate change. There's no hedge really against climate change, but if you are, you know, actively putting assets into a balance sheet, for instance, that are sustainable, that are resilient in terms of a transition to a low carbon economy, and you're funding that with, you know, lower cost at times bonds, you're moving your balance sheet in the right way, and it's a forward-looking resilience play. And so regulation has played heavily into that. I think what we see is a heightened sense of potentially, I suppose you want to say there's a values piece, but there is a heightened focus on impact, on what companies are doing with their money, what individuals will do with their own money, their pensions. That obviously feeds through in terms of the funds market, in terms of pension market, and I know there's pension and insurers here today. The demand for that is increasing, and so in order to feed that, there has to be something to invest in. I think then in terms of, and again, that's kind of that investor commitment. So there are investors out there whose full mandate is to only invest in these types of instruments, or at least to limit what they will invest in terms of fossil fuel. And so there's competitive advantage in issuing in this market, but then equally investors see that value. It can be contentious. We would have seen a lot of ESG funds do particularly not very well, I suppose, over the last 24 months, given the market and what would be in those funds. A lot of tech, and tech has had its problems. But on the whole, it has held its own. And then finally, you know, innovation, financial engineering, these are things that have always been present in the market, irrespective of whether it's sustainable or not. And there is always alpha to be made. And I think that that innovation is definitely something that we see play through in terms of the instruments. So I suppose it's probably the graph on the very right-hand side is probably the one to look at. It's a loan market, but I think it's a little bit more obvious than the bond market, because the loan market obviously services a lot more private private issuers. And you will have seen a huge growth between 21, 22, and then up to 23 post-COVID. A huge demand for sustainable lending. We also have a period of time there where we have banks who are trying to green their books and trying to look at more sustainable ways in which they can lend. A lot of them setting targets, some of it regulatory driven. If you're a European central bank regulated entity, for sure you are under pressure. We do see, however, a fall off, in 2024. It has been an incredibly difficult market, I think, generally. But we are starting to see a correction in terms of inflation and rates. And so, potentially that will come back up. It was pegged to be a great year. But I think through the summer issuance hasn't been great. What I can say, though, I suppose, is that from 2020 to 23, and even if we take a fall off in 24, this is a buoyant and healthy place to be looking to either go out and fund yourself or indeed to be somebody who's investing in those loans. So what I wanted to just spend a little bit of time on is just in terms of, I'm sorry, I'm not on a roving mic, it's just in terms of the actual instruments that are there. And so when we talk about sustainable finance, it can feel quite nebulous in a way, like what is it exactly? If you're a fund, you need to invest in something that's green, that's either an actual physical asset, it's something in infrastructure, or it's an instrument. If you're an issuer, how do you go about it? So again, coming back to the market has derived these instruments effectively through collaboration, through groups. The ones that are in the honeycomb or the kind of bee comb there, they are a mixture of the Loan Market Association and the International Capital Markets Association. Both of these have obviously participants from the market developing them. Really the genesis of this was to create instruments which were transparent, which could be, effectively would protect against greenwashing for the issuer in the first instance. But secondly, if you were a buyer and you were putting these into a fund, that you understood what was there. They are framework based. The difference, I suppose, is on your left to my right. The asset-based ones would have been the more traditional instruments. So the green bonds, for instance, so it's a use of proceeds bond. You go to the market for a fixed amount of money, usually 500 million and upward. You raise that in the bond market, and then you take that and you either have already the assets, or you buy the assets, or on a future piece. Additionality is really important. Are you investing in projects you wouldn't have invested in before? And so the green bond market, which was where I issued my first bond, was under the Green Bond Framework, and that was developed in 2018. And effectively, it creates rules and governance around what you do with those funds while you have the bond outstanding with the investors. Alongside that, as I said, there's work that has to go into that. You have to be able to measure the impact of that. So avoided emissions is a good example. Scope 4, sometimes they call that in the market. I just used to like to call avoided emissions. So what did for 1 million of investment, what was the savings in carbon emissions from a project in renewable energy or green homes, or one of the categories? So that is where the traditional, I suppose, green bond came from. But that has actually expanded now. So now there is a market in social bonds where you can fund social enterprises, social initiatives. Again, impact is really important there. A smaller part of the market, but I think becoming more important as we start to look at the S. I think everyone focused on E for a long time, and for the right reason. Obviously, we have climate change to adapt to, but there was earlier on, Hannah spoke about just transition, leaving nobody behind. Social bonds can play a very important role there. And then I think moving on to the right-hand side, or left, the general corporate purpose. So these are more, I would say, a newer innovation. They are where you can effectively lend the money for anything. So there's no sort of circular put around that money. You can use the money to fund your business in any way, but you now have to meet targets in order to effectively have the loan outstanding or the bond outstanding, and there's a ratchet. So if you are successful in meeting your targets, if it's in the bond market, you will pay maybe 25 bips less than you would have. on your coupon or 25 bips upward. There's no science to that. The market came up with it and it seems to be there. One would argue that there should be different levels of ratchet depending on performance, but 25 basis points is where it was set in one of the earlier issuances. In the loan market, slightly different. It's on a much smaller ratchet, 3 to 5 basis points, and that's due to an accounting technicality. But the idea of these loans is that now it opens it up to much broader business in terms of if you don't have distinctive green things that you want to fund, you can now fund a business more sustainably. So it helps with the transition. And I think this has been a really nice innovation, I suppose, because transition finance is one which is hard to crack. It's usually reserved for real fossil fuel heavy companies, or indeed those which are, having to make a real transition away from fossil fuel. So the sustainability linked is something that's a bit more palatable. Interestingly, it's the one that has probably suffered the most in terms of greenwashing, in terms of reputational damage. And so the market has sort of come around it to create these principles. And it's something that we have started to see in the loan market, I think, the quality raising of those issuances. So I think it's just really important to sort of, when you hear about sustainable finance and you think, okay, well, what would we do? These are real frameworks, real tangible things that can be utilized in order to either, if you are buying assets, to understand what it is you're buying. They're an ICMA aligned, or there are other frameworks. So the climate transition framework, that's obviously one, but there's also Climate Bonds Initiative. They've come up with a taxonomy in terms of what is green and what is not. They also have looked at sustainability linked. So again, market driven, transparent, and it means that you can have a label on something and it makes life a little bit easier. They're all freely available online. They are refreshed usually once a year, but there was actually a refresh of the guidance handbook only yesterday for the bond principles, which is a useful piece for the market because it allows clarification. As we see the regulatory reporting environment increase, particularly in Europe, I expect that the transparency around these loans and bonds will actually just be enhanced, because now you'll have more, let's say, touch points to be able to, verify what's in front of you in terms of a lending piece. But again, just the takeaway here is that this is a lens over credit for public, private. There's 57 sovereigns, I think, that have issued in one or more of these formats. They are really useful instruments in being able to direct funding legitimately towards environmentally sound objectives. And I suppose I just wanted to just focus a little bit on sustainability linked loans, because they are something which can be given real economy lending. So it's something that we see in Ireland as being quite an important tool, I would say. It's used. A lot of our financial institutions would focus on this. Effectively, as I said, allows them to lend to greater amount of organisations, and as I said, on a more general basis. So you could lend to a mid-sized company. They don't have to have huge green assets. You don't have to create this big green loan. You can do it in a sustainability linked, and if they perform, then effectively you can they can get a reduction in their costs. I think they're also a very useful tool for de-risking or deleveraging balance sheets, particularly for banks, and I do speak about banks in this instance. Why? Because they actually create great engagement between the relationship between the borrower and the lender. I think there is, generally now all loans have some element of a sustainability linked element baked into it. It's derived by the Loan Market Association in Europe. It means that every relationship manager that goes out to lend has a conversation now about sustainability, has an understanding of what that business looks like from a resilience perspective. And so from a credit perspective, actually helps the bank in its credit decisioning. Again, really important, because those banks are also regulated. They are looking to de-risk themselves, or at least understand their risk from a climate perspective. And having instruments in place where there is ongoing engagement is really important, and these instruments do that. As I said, there's a performance target set. Those targets may or may not be met. I think more and more what we are seeing is banks who might have sustainability targets themselves, so science-based targets for emissions, for example, linking that to the type of lending that they are doing. So again, it's giving real pass-through, I guess, in terms of that investment value chain. The banks, I guess, moving the economy a certain direction in terms of sustainability. As I said, not without their problems. There has been concerns over greenwashing with them, but I think managed correctly are a really important tool, and I think will continue to be so. Excuse me. And so I suppose that's really kind of where I wanted to go in terms of the frameworks and that themselves. It was really just to link in to say, you know, you're standing now at the start of a strategic roadmap. What's really important, I think, and what I have learned in terms of my own career to date in sustainability, the work I do with my clients, it's really about capacity building, knowledge transfer, I suppose, understanding instruments like these, but equally, you know, I know there was a conversation earlier in terms of, you know, how do you, you don't make the investment decisions for your investees if you're an insurance company or you have pensions, but actually being able to understand what funds your customers may want. Intergenerationally, we see that there is a much greater demand for ESG-focused funds. And so, as I said, again, it's about understanding what exactly those funds would be invested in. The regulatory piece is still very large in the UK. There will be labelling. There's labelling, obviously, for funds as well. There is a focus on SLLs in terms of that transparency piece, and there is a buoyant green bond market and social bond market there as well. So in conclusion, I suppose what to take away from it, there is so much opportunity within sustainable finance for innovation, for, you know, in terms of supporting, it's just a lens. So it's supporting an economy, it's supporting supporting businesses and what they do, but actually from a resiliency perspective. There's great returns in terms of engagement, and actually if you're out and you're doing the right thing in the market, there's lots of access in terms of capital and investors. It is an underbid market, or an overbid market. There is, you know, obviously more demand than there is availability. And I think it's just about understanding that within the roadmap, there is lots of opportunity for, I guess, bringing these finance instruments alive, being part of the sustainable finance market, contributing to the debt market in that way, and indeed ensuring that it continues to evolve and innovate. So thank you very much.